Hey, everybody. I'm so excited here today. Thank you for joining us. And this is my very first podcast. I've been planning on doing a podcast for the last couple of years and really didn't know where to start. So I've done some research and hired some awesome professionals to help me put this together and to share with you. Our podcast is The Stamp of Approval. And I'm Kristen Stampini, co-founder of the Stampini Real Estate Group here with RE/MAX in Boca Raton, Florida. I'm also a certified real estate coach for Craig Proctor and the owner of Global Virtual Real Estate Assistants. I'm a real estate investor and a national trainer and public speaker. And also, recently, I have opened up a inside sales agent business and am training inside sales agents for other real estate professionals. So I'm so excited to share the real estate industry to all the realtors out there and the knowledge that I've gotten over the years and years of being coached and being with so many incredible realtors in North America and also so many awesome professionals around the country. So here today, I'm real excited. My first guest ever, we have Matt Weaver. And, if you don't know Matt, such a pleasure having you here, Matt.
Well, thank you so much for the opportunity. I'm excited to be your first guest.
Yeah, and I'm so excited to have you. So Matt Weaver, just a little bit about him. He is the senior mortgage originator for the Matt Weaver team at CrossCountry Mortgage. He's unbelievable, and I've worked personally with Matt for several years now, and he has more than 20 years of experience in the business and has helped over 10,000 families buy and invest in the residential real estate and locally. Okay. Today, what we're going to be talking about, Matt and I, is the true costs of home ownership. Okay, because I don't think people really understand that. And getting into the details there, and also current interest rates at where they are today, and where are they headed with the feds and everything else? Because we know that all that's coming up, and also really the simplicity of mortgage financing and the ease of really qualifying for a home mortgage. So, Matt, tell us.
Well, thank you. Thank you so much again. And I'm really, really excited to be here. It's interesting because as we enter into what we'll call a little bit of a different market, I think it's important that we take a look at the landscape of our market and understand how we can maybe retool our approach in our sales, right? Meaning our sales approach. And what I mean by that is I was sitting thinking about this the other day, and I said to myself, how many people, whether it be consumer, whether it be real estate agent, know how to articulate the true cost of ownership?
So true. So true.
The true cost of ownership. So I wrote down a couple figures here, and I said to myself, what if I told you and or the audience that a $315,000 house costs approximately now about $707 a month?
Wow. How did you figure that? How did you figure those numbers?
Now, that sounds crazy, right?
Absolutely.
So I want us all to think about this for a moment. And again, now, I'm not an accountant, so we're going to verify this. However, these numbers are going to be pretty close. So if we take a $315,000 house and put down 5%, which is only $16,000, I want to emphasize that because, you see, from a consumer perspective, if we asked 10 people in a row that don't sell real estate, what does it cost to buy a $315,000 house? 80% will tell you somewhere between $40,000 to $60,000, and you need this unbelievably high credit score. So let's first start off with 5% down can get you into that home, which is $16,000. That would mean we have a loan amount of $300,000. Now follow me here. Principal and interest on that loan amount would be $1,610. I'm going to use $250 a month for homeowners insurance, $400 a month for real estate taxes, and $132 for mortgage insurance, giving us a grand total, Kristen, of $2,392 a month in terms of a monthly payment, right?
Wow. Okay, so let me just ask you a couple questions there, if that's okay.
Yeah.
Okay, so first of all, the price to rent a home is, usually anywhere between $1,500 to on up, right? Depending on what you're getting. So $1,500 a month. So for an extra $500, and I know you're going to back it out, I can own a home.
Right.
Okay.
And then the rule of thumb is on, let's say, a home of $315,000, usually the rent factor is about 1%. So if we think about that same $315,000 house, we're looking at probably somewhere in the neighborhood of $3,100 a month, roughly.
Right.
But getting back to the payment and how we derive at a real cost, a true ownership cost of $707 per month. So if we understand that the principal, interest, taxes, and insurance are $2,392 per month, let's now dive into the numbers. The first question becomes, what is our tax deduction? And so what I did was I broke down that on a monthly basis, $800 of that payment is interest. So that means $9,600 of that annually. Well, that would add up to $9,600 a year in annual interest. Real estate taxes. If it's $400 a month, that would mean $4,800 a year would be the real estate taxes.
Right.
So we add the two together, which is $14,400. Assuming, Kristen, a 30% tax bracket, that would mean a true refund, not potential, not you might get it from the government, a true refund of $4,320 a year, meaning $360 a month.
Wow.
So if we have a $2,392 payment, we understand that $360 of that will be coming back to us for owning the home. Let's go a little further. If we understand that of the $1,600 worth of principal and interest is principal, meaning 800 of it, that would mean, let's think about this now, principal is money coming out of our personal savings account and going into our home savings account. So that $800, which is $9,600 a year, is going into our home savings account, right?
Right.
So we have to take that amount of money, because it's our money going into that savings account, off of the monthly payment. So that's another $800 a month. So far we have $360 coming off the payment because of our tax deduction, $800 because of our principal, and last but not least, using a 2% annual appreciation, which is ultra conservative. True or false?
That's true. Absolutely.
Ultra conservative. So that's less than the cost of living, would be $6,000 a year roughly, which would be equal to $525 per month. So I know this is a lot of numbers we're throwing at you. So let me just do the quick math. We start off with principal, interest, taxes, and insurance of this payment being $2,392. We minus our tax deduction of $360 a month. We minus our principal payment of $800 per month. And we minus our appreciation of $525 a month, giving us, Kristen, a true cost of $707 a month based on these facts.
Wow. That's crazy.
Isn't that interesting?
Yeah, very interesting. And you know, when I'm thinking about that, and I'm thinking about, okay, and it's kind of funny because as I was telling you, you know, before we got started here, that I was actually talking about this with our real estate team this morning, and we were talking about, you know, when buyers are looking about a difference of, let's say, $5,000. So let's say it's $300,000 that the buyer wants to pay, and the seller really wants $315,000. Okay, and they're both stuck at those numbers. The seller's stuck at $315, the buyer's stuck at $300. How can we meet in the middle, or how can we explain the value of still moving forward, and really what is it going to cost them per month? So at a 5% interest rate, okay, we're looking at per $1,000, what is it, $5.25?
Exactly.
Okay,
exactly.
So if you think about that, and we're going to sit there over, you know, 15,000, and let's say we break it in half and let's do 7,000, and we're only paying $5.25 per thousand, you know, for the buyers out there and for the agents out there, that's what you got to be talking about, right?
Absolutely. You when we're in this type of environment now, we have to sell payment as well. Payment is essential for unloading inventory.
So, I mean, that's only $35 more a month.
$35 more a month. We think about that, right?
Right. You know, that's what, a cup of coffees at Starbucks?
That's right. Maybe two.
Right, exactly. Yeah. So, I mean, I'm a numbers person, okay, Matt? So I can totally understand and relate to the numbers that you're talking about. Other people aren't so much numbers people, but the bottom line is when you're working with different professionals and things like that, and they can really explain it to you and how it works out to basically buying a home at $315,000, and the actual hard cost to you by the time you back out everything is only $760 or whatever dollars a month. That's just amazing.
It's incredible.
Why isn't everybody out there running to purchase a home?
Lack of education. You see, our industry does a poor job in providing this type of data. And so I think we could do a better job, and I'm referring to the mortgage side of the industry more than just the real estate side of the industry. We don't educate the consumer enough as to what the true cost of ownership is. Now, of course, there's going to be maintenance that you have with the home and so on. But when you stop and think about it, now we're using a 2% factor in terms of appreciation. I think we can all agree that's a very low number. Very low.
And here in Florida, I mean, obviously depending on the market, but I mean, even 4% is quite low. Okay.
Absolutely.
So 2%, and I respect that you're being very conservative about your percentage just so people can understand it. But that's just crazy.
It is. And when you think about long-term ownership, you always hear the stories about our relatives up in the Northeast that sold their home and moved down here, owned it for 10, 15 plus years. When you look at their acquisition price versus what they sold for, and you net it all out, even with maintenance, half the time you've owned the home for free.
Wow.
And sometimes in a profitable situation. So homeownership is really the American dream and really designed to get you there. Now, of course, there's a lot of different factors at play, but long term, I think we can all agree you can never go wrong.
Absolutely. Absolutely. And I mean, what is the home ownership? 67%, I think, on average.
We're falling in still the high 60s, which is still at its low point, relatively speaking.
Right. So tell me, where are we at? Where are we headed? What's going on?
So when we think about the overall market and where we're at right now, a couple things. We go back to the educational component. And the biggest challenge that I think people have, and even agents as well, is not understanding how simplistic mortgage financing is. Folks, mortgage financing is simple. And I'm going to be the one to call that out. I was asked from a good friend of mine. I've been contributing to CNBC for years. And one of the questions that Diana Olick asked me, she said, so Matt, tell me a little bit about where the mortgage market is. We're doing an interview about the past decade, right? From 2008 to 2018. And where are we today? And the truth of the matter is that it's never been easier in a sense to get mortgage financing. Think about this, Kristen. You now have FHA government programs to where there's no credit score requirement. Let me repeat that. No credit score requirement.
So tell us about why.
So the way it works nowadays is it's through automated underwriting systems. So for example, we approved someone with as low as a 550 credit score just 2 weeks ago. So when we think about that, now don't throw tomatoes at me. Okay?
I was just thinking,
right?
wow.
I'm just the messenger here, folks. Okay? But virtually no credit score requirement. But you can use baselines. 580 credit score is acceptable. For conventional financing, 620 is acceptable. So these are not the highest of scores. Down payment, as little as 3%. And we also nowadays have these government grant programs that are built into the loan product. So you're not running around from city to city trying to see who's got the money. We actually have a product that we actually give you the money through the loan product. So you're putting down zero. Think about that.
Wow. That's unbelievable.
Unbelievable, right?
Yeah. And like you said, though, thinking about it and everybody out there it's about education. So just like all realtors are not the same, right? And it's about education, a lot of it. And neither are loan officers and lenders and direct lenders and such, right?
Yeah, because see, in the lending world, we're just so busy facilitating. We're not getting from behind the desk and out there and being an advocate of our industry. And, my clientele base, I have the good fortune of saying I work with some of the most wonderful producing agents such as yourself. And it's something that I'm super passionate about. And I think that we need to be the messenger here to get that point across on what the true cost of homeownership is, how simple it is to qualify for financing. Think about debt to income ratios for just a moment. I mean, we can go over 50% debt to income ratio. That is your income up against your housing expense can be over 50%. So when you think about that, we have co-borrowers that we can bring on. If someone doesn't qualify, mom and dad can jump on the loan. There's so many different avenues to get them a home.
Let me just ask you real quick, just a minute. Explain what it means by debt to income ratio, because a lot of people out there don't really understand that. So
Absolutely.
What does that mean? What's the back end? What, just real quick, maybe just go over that.
Sure. So let's assume for a second, let's use a $5,000 a month income. Right? And let's say that someone's mortgage payment is going to be $2,500 a month. That would be 50%. Right? So their income is $5,000. Their mortgage payment would be, let's call it $2,500. So the front end debt ratio, we want to be right around 45%. So that would mean on a $5,000 a month income, their monthly payment would be right around, their maximum monthly payment would be right around $2,400, which would be about, let's call it 46% of their income. So if you think about that, that's almost 50% of their income can be used for the mortgage payment to qualify. It's a big number.
Yeah, that is a big number. Don't people get scared about that number?
Depends on who you're asking. Okay?
Well, just like you said, though, I mean, look what it does is it builds wealth.
It builds wealth. It builds wealth.
Okay. So where are we headed? I know, interest rates have been creeping up just a little, all-time low still, but they've been creeping up a little bit, right?
Yes.
So talk about that.
So interest rates are up about 0.75% in the past, we'll call it 9 to 10 months. Okay. So we are what we would refer to as in an ascending rate environment. So rates are moving up. Okay. So rates right now are falling anywhere between the high 4s to low 5s. Okay. Depending on overall profile. And I have to tell you that it's an interesting adjustment on a day-to-day basis in terms of communicating that 5 number.
Yeah,
okay?
Right.
We almost need another 6 months under our belt to communicate 5 so everyone just understands that's where we're at. Right?
Yeah, absolutely.
Because it's a very fresh number for us all because we've been artificially low for a long time.
Well, I remember my first place that I bought back in, I believe it was 1991 in California. I paid 18%.
Oh,
you remember?
Right.
You're probably too young for that, but that was way back in the day. But still, right? So 5%, I mean, that's just amazing.
It's still a bargain. It's still a bargain. So the rate, the movement has adjusted. Now, the Federal Reserve is actually scheduled to meet tomorrow, which the full anticipation is they will increase the federal prime rate once again and one more time by year end. So the federal prime rate right now is at 5%. It'll probably end up nearing 5.5% by year end is what we would think. But let's put all of that into perspective. The truth of the matter, Kristen, is we should have interest rates. I mean, interest rates should be around 7.5%. Mm-hmm. Let me repeat that. And I'm a mortgage guy saying that, right?
right.
So people are probably thinking, what is this guy talking about, right? But the truth of the matter is that if we're at 7.5%, that means the banks are giving you 5%, 5.5% on your CD, right? That means the fixed income retired borrower is getting more money on their savings, more money circulating. So if the Federal Reserve feels confident to increase rates, that means we're doing good as a country, as a whole. Our economic position is gaining momentum. We're creating more jobs. Dow Jones right now is trading at an all-time high. So it's directly tied into all of the external factors that we have. So someone can, let's say, pay 4.875 on an interest rate, which is up 0.75%, but their 401k is up 25%.
That's right.
I mean, what do those numbers really look like when you think about it?
So when you're talking about going up 0.25%, okay, let's say, and who knows what's going to happen tomorrow, but let's say it's 0.25%, and I'm purchasing a home at $300,000, and now it's gone up 0.25%. How much is that?
25 basis points, 0.25%, let's say on a $300,000 loan, is going to be somewhere in the neighborhood of $20 to $25, roughly. Okay. Using that as an example.
So we shouldn't, because we have buyers out there that are scared. That they're like, oh my gosh, my interest rates are going up. Let me wait another year. But they aren't looking at, hey, prices are going up, interest rates, So why is it a good time to buy right now?
So interestingly enough, I personally feel it's a great time to buy and or to sell. And very rarely are we in that type of market. Usually it's a great time to buy, not that great of a time to sell, right? And then vice versa. That's right. I think a seller can get really great value by selling today. And I think a buyer can get really great value by buying today. And what I mean by that is I know the mindset right now is we're entering into this shift. We're in the twilight zone, Kristen. Okay,
Right.
It's going to come, right? We're entering into this market that we could see this crash again. And the truth of the matter is that I'm going to take a contrarian position on that. There's a couple things. Number one, there's an amazing study that I'll provide to you and you can provide to your listeners that Harvard did, that it shows the crash-to-crash cycles were 18 years perfect, dating back to the 1800s with the exception of 2 occasions.
That's right. Yep.
Crash to crash, right? So if we are history buffs, okay, which I happen to be, that's 2024, okay?
Right.
Not
Yep.
today. But moving along from there, the Federal Reserve is already taking measures in place by increasing rates to slow down house prices. Now, for all of us that own real estate, we'd love to see real estate go up 20, 30% a year. Okay, but I think we can agree that's not good for the greater good.
And it's not realistic today.
Right, and it's not realistic. So if we are tapering back in terms of that appreciation and seeing 2, 3%, it's a very healthy market. And look, we might see some price deterioration where there's a little bit more inventory. Perhaps there's land all around these subject properties where there's competition. So they're going to see probably a little bit of price decreasing here in certain subsets of the market. But that's a natural way to offset interest rate costs, right?
That's right.
So about $10,000 in decrease in sale price offsets about 0.25% interest rate.
Yeah. So, and I know the listeners here, today are going to be a lot of realtors, and also there's going to be consumers as well, buyers and sellers and everything else. So to, really recap and close this as our first awesome episode of
Love
the
that.
Stamp of Approval.
Love it.
Give us some insight.
So if you are thinking of buying today, don't wait any longer. If you have a correct plan in place, if you understand what your length of ownership is going to be, a home is not trading stock, okay? It's not trying to sharpshoot a bottom. That's not how wealth is created. The purpose, I was told by a very wise man, the purpose of real estate is to own it.
That's right.
And so if we think about it from that perspective, a home houses our family. It brings us a lot of joy. It brings us a lot of financial benefit. It brings us tax deductions. A whole host of ancillary benefits come along with being a homeowner. I wouldn't overthink where it is today, what the value can be tomorrow, etc. We all know that if we put a long-term time frame on real estate, we will almost never go wrong, Kristen.
That's right. And so and that's great, for the home buyers and for the realtors, how can they stand out from all the other realtors when working with buyers? How can they stand out from other realtors?
Knowledge base and your approach. The more that we are ingrained into what we're doing, the more that we love what we're doing, the more we're going to stand out. And the truth of the matter is that just like you, Kristen, I am in my business. This is what I do. And I'm a constant student of my business. And the more that we can all do that, it's going to stand out in your listing presentation. It's going to stand out in your buyer presentation. And they're going to say, you know what? I want to work with that expert right there, because they can give me sound advice because they're really doing what they should be doing.
And it's so true. I mean, I was talking about being a real estate coach. So, across North America, I coach 70 realtors in success of real estate. And the thing is that I am always a student. They say, oh, do you ever get enough, too much education? The answer is no. Absolutely not. And we do want to stand out from the rest. And what that advice that Matt just gave is awesome. And being a homeowner, educating the homeowners today is where it's at. So anyways, let's make this a close for my first episode ever of the Stamp of Approval. And, if you like this, I definitely say, hey, please share it to other realtors out there, across North America, and also the consumers who are watching. So Matt Weaver, thank you so much. And we're going to close this for today. Thank you.
Wonderful. Thank you so much, Kristen, for the opportunity.
Awesome.
stamp of approval.
Matt, for the homeowners and for the realtors out there, how can they reach you?
Absolutely. So, agents, I run a team of 32. We are committed to you as real estate agents. Built out a practice that really specializes in what you do in terms of sales. So we understand your sales process and we specialize in your needs. Now, we operate 7 days a week from 8 a.m. to 9 p.m. and no, that's not a punchline, okay? So our direct dial is 561-864-2458. Again, 7 days a week, 8 a.m. to 9 p.m. To any potential home buyers or consumers that are out there thinking about purchasing, please reach out to us. What we do differently is we take our time up front to give you the clear, concise information you need before making any big decisions. And we're really passionate about that. Whether it's your first time buying, whether it's your second time, or whether you're the most seasoned investor out there, we understand it. We get it. We've been doing it for 20 years straight, and we love what we do. So I look forward to hearing from you.
And thank you, Matt. I mean, he does an absolutely amazing job. Are you in 50 states? I mean, how many states are you in?
So CrossCountry, virtually the top 10th, 15th largest provider here in the country. We are in every state. So we can
reach out for you anywhere.
There we go.
Okay, awesome. And just for me, okay, Kristen Stampini, I'm gonna leave you website, podcast, everything else, phone number to reach me. It's all gonna be in this episode, so you can also reach out to me as well. Okay, thank you.